Hey folks, this is Zoom Out with TouTzuSays, and this is my Q2 2025 outlook. Is there method to the madness? Before we get started, full disclaimer. This is not investment advice and should not be taken as such. This is for your entertainment only. First, a quick recap of what's happened in markets since Trump was inaugurated. At first, Europe and China outperformed the US, but since then, everything everywhere has come down, with the US being one of the worst markets in Q1. Reflecting back on my original 2025 outlook from December last year, overall, I think my broad forecasts were pretty accurate, but the timing and speed of Trump 2.0 has been much, much faster than expected. I wanted to highlight this what is page as they've become the key fork in the crossroads for how the rest of the year unfolds. The Fed, what will they do? Will they cut rates? Musk, is he staying or leaving? The mythical Mar-a-Lago Accord, is it real or not? Will Trump have the courage to put the US economy in a hole? Will US isolationism actually work this time? These are tough, pivotal questions that can guide us if we forecast well. So let's get started. First, I'd like to introduce you to the first concept, Ferguson's Law. Based on economic history, Ferguson's Law basically says when debt service, or the amount of money a country needs to pay on its borrowing, exceeds its spending on defense, the empire declines. For the US, we just hit the trillion dollars debt service level, while our defense spending is about 900 billion. For many Republicans and business leaders, this is alarming and drives the urgency to want to do something now to prevent the decline of the United States of America. A quick refresher, this is what it looks like for the US federal government fiscal year 2024. As you can see, our federal spending of 6.75 trillion far exceeds our federal income of 4.92 trillion. To make ends meet, the US government goes to its credit card, the US Treasury market, and borrows the deficit by selling US Treasuries. Obviously, borrowing this money is not for free, ergo, debt service on this debt. To oversimplify for clarity, the goal of Trump 2.0 is to shrink the pink expenses, grow the green income, and cut the black deficit. Doge was supposed to shrink the pink, which would simultaneously lower government expenses as well as the debt service. Meanwhile, Trump wants to boost tariff income to over $500 billion a year, lower taxes so consumers have more money to spend, and boost the GDP with more US exports and less US imports. The theory is sound. In reality, the true tectonic plate that needs to be managed ASAP is the deficit part. When the US borrows on its credit card, it actually has the option to borrow short term, mid term, or long term. Over the past years, we aggregate that lending into maturity years, and 2025 is a doozy, with a total of about 7 trillion of US treasuries maturing in 2025 and roughly 2 trillion of new borrowing needed to keep the wheels on the cart. If you were the Secretary of Treasury, this is a big headache. You have to convince investors to lend money to you even though they know you have a massive amount to borrow, and you want to borrow at the lowest interest rate possible. Treasury Secretary Bessent has a plan, which he calls the 333 Plan. He has set and announced explicit targets of 3% GDP growth, lowering the deficit to 3% of GDP, and adding 3 million barrels of oil a day of US oil production. So, a quick side note, the oil production target is primarily to keep inflation down, as well as boost US exports. Finally, what was not explicitly said until recently, Trump wants to replace Fed Chair Powell with a loyalist in 2026. If the new Fed chair will cut rates, it could help coordinate Fed and Treasury policies and lower US borrowing costs. Digging deeper, Bessent is a macro hedge fund manager and is highly regarded for his understanding of global financial and economic mechanics. There are two important but not obvious targets that he wants to achieve. By cutting the US deficit, the goal is to regain global trust in the US. The point is to show the world that the US is fiscally responsible and therefore worthy to be the global safe haven currency and bond. Second, Bessent has convinced Trump to focus not on the stock market, but the 10-year US Treasury bond yield. The 10-year U.S. Treasury is the anchor interest rate for mortgages and U.S. bank lending rates. When this yield comes down, so do all the other lending rates, irrespective of what the Fed sets the interest rate at. Of course, if the Fed joins the party, there's extra power and less rate arbitrage. But the reality of Besant's plan so far is less than ideal. First, Doge cuts were supposed to be about 2 trillion, then 1 trillion, but the actual right now is only about 150 billion. This is too small to move the needle on reducing debt and debt service. Second, the uncertainty of tariffs and its destructive effect on consumer and CEO sentiment has killed any desire by U.S. energy producers to drill, baby, drill. Although the Saudis and OPEC are playing along with Trump right now and getting oil prices lower, U.S. producers are only seeing their profit margins fall with lower prices and are unlikely to boost production by much. Finally, the targeted 10-year U.S. Treasury yield did at first come down to 3.85, but has since rebounded higher to over 4.35%. This is highly, highly undesirable for Besant and Trump. It's embarrassing if it persists. By attacking the whole world at the same time, there are few allies who are interested to double down on the U.S. while they're getting threatened by the orange one. The bond vigilantes are not impressed. This is an old chart, but as of April 17, 2025, the 10-year U.S. Treasury yields were about 4.35. With yields rising, there's been much speculation about who is selling U.S. Treasuries in quantity to cause Treasury yields to go up. TikTok is saying it's the Chinese dumping Treasuries, thus increasing the supply and allowing investors to demand a higher yield. In reality, it probably wasn't the Chinese. If China wanted to dump, they would have sold their treasuries, ended up with a bunch of US dollars, and then sold those dollars to buy renminbi or some other asset like gold. But since the dollar yuan index actually went up during this period, it means there was no abnormal high volume selling of US dollars by China. It was probably the bond vigilantes in Japan, Europe, and the UK. For your education, the bond market is at least twice the size of the global stock market. It's where institutions invest the majority of their money. So when they make changes from bonds to stocks or vice versa, it moves the entire market. The bond market is also much more rational and calculatable and tends to be driven by professional investors. Historically, the bond vigilantes have been able to influence governments and currencies, and they essentially forced Trump and Besant to back off. The whisper level for U.S. Treasury yields is around 4.5%. They're calling it the Trump put level that would force Trump to change course, as he did when he paused reciprocal tariffs. Of note, the only thing that I know of that can defeat the bond vigilantes is the U.S. Federal Reserve, headed by Powell. If Powell launches QE, he has more money and power and durability than the bond vigilantes. But if Powell decides to stay on the sidelines, we're going to see the bond vigilantes exert their power over Trump and Besant. Here's an interesting chart and dilemma provided by Jim Bianco. The hard economic data, such as the ISM and PMI indexes for services and manufacturing, is indicating that the US is slowing but not collapsing under the weight of Trump policy. However, the soft economic data, such as consumer and CEO sentiment, has fallen off a cliff. Which is right? Bianco notes that if we don't see the hard data falling in the coming weeks and months, then maybe it's all just hype and fear-mongering. Stocks would rally if that were the case. Conversely, we're also hearing from CEOs and thought leaders that we're already in recession. For once, my gut is telling me that the soft data is leading the hard data. The outlook for travel bookings and port freight activity from people on the ground floor sounds pretty bad. The next Fed meeting in May is absolutely pivotal. In a normal environment, the Fed should be motivated to cut interest rates to match the market. Here, we're seeing 2-year U.S. Treasury notes at 3.67%, far below the Fed's current rate of 4.375%. This means that it makes more sense for banks to deposit excess funds at the Fed, earning 4.375%, rather than take that money and lend it. Ultimately, this takes liquidity out of the economy and markets, which could cause market hiccups. However, if the Fed is concerned that Trump policy will drastically increase inflation in the near future, they may choose to leave the rates and wait for more data. This is a stated position of the Fed right now. Quick slide to reinforce that despite Trump's best efforts, he hasn't been able to get the US energy producers to drill, baby, drill. In reality, it's going the other way. The US is likely to eke out some production growth, but I highly doubt we'll get to the 3 million barrels per day increase. The question is, has Trump become an idealist in his second term? Is he really willing to put the US in deep economic pain in order to, quote unquote, fix America? Aside from the Trump put at 10-year Treasury yields, maybe his approval rating is another indicator of his resolve. It's worth watching. As his approval rating falls, it becomes more likely that Republicans in Congress revolt. So my off-the-cuff crazy deficit forecast for 2025 and 26 that I made last year seems like it's holding up despite my extreme lack of expertise in this space. Remember, the US federal fiscal year ends in September. As we just filed our taxes, the GDP and strong markets of the last few years will likely reflect higher income and capital gains taxes for this year. Later this year, we're going to see tariff income rise into 2026, but I expect that it will peak out by mid 2026 and begin to decline as consumers slow their spending. Meanwhile, on the expenses side of things, Doge will save some government spending, but nowhere near the $1 trillion mark. Trump does not look like he has the courage to touch Social Security, Medicare, and Medicaid. And I doubt he'll cut back on defense. Whatever cuts they make, I bet that money just gets funneled into a non wasteful part of the defense spending. Net net, I can't see a smaller deficit for fiscal year 2025, but maybe there's a little wiggle room for 2026. The impact of Trump policies won't make a significant impact on his fiscal responsibility pitch. And now, here's core concept number 2, the Thucydides trap, coined by historian Graham Allison. It states that when a great power gets threatened by an emerging power, 12 out of 16 times there's war. Today, the US is threatened by China in terms of economic power and innovation. It's normal that the existing great power feels threatened and begins to aggressively try to protect its pole position by putting up barriers, getting other countries to put up barriers, and flexing its military and financial muscles. Sadly, we as humans are not that involved, and we keep repeating the cycle of civilization. We happen to be in one of these great conflict eras, but the chess pieces are different now. Aside from the risk of nuclear war, we also have to compete in cyberspace, outer space, under the sea, as well as financial, economic, trade, and technology arenas. With rapid improvements in AI, we have a future of abundant expertise and smart robots. So, with the Thucydides trap framework in mind, here's what I believe is Trump's game plan. The first step is to unequivocally make China enemy number one. Nothing else in the world matters. Trump wants to disengage with the rest of the world in order to concentrate all energy, attention, and monies to this great contest. If he needs to give away Ukraine to get Putin to unite with China, he'll do it. If he needs to move the military out of Europe and the Middle East to Asia, he'll do it. If I'm right, Trump will cancel all reciprocal tariffs if the other country agrees to put anti-China tariffs in place. Second, rebuild America for national security and self-sufficiency. I've discussed this in the past, so I won't go into details here, but the bullet points below with the policy will be policy long after Trump leaves office. Third, Republicans and business leaders are serious about trying to get the US out of its debt cycle. Although the rest of the world is as bad or worse, restoring faith in the US dollar and treasury is not only prudent, but also a weapon to fight China. In the simplest terms, it means a painful fiscal diet for Americans, boosting exports and boosting population growth. And finally, for Trump, there's also the matter of his legacy. How he prioritizes or sticks with this game plan could depend on what his approval ratings look like. Part of Trump's strategy is also the rejection of Chinese dollars from investing in the US. It is rumored that he will force Chinese stocks off the US stock exchanges, block Chinese investment or acquisition of US companies, disincentivize Chinese investors from owning US stocks, and lowering the amount of US treasuries held by the Chinese. Specifically, there's been a lot of speculation about China dumping US treasuries and causing the 10-year yields to rise. We already shared why this was not the likely culprit this time, but no doubt China could dump en masse and cause temporary mayhem. Rationally, this would be really stupid for China to do, to create your own panic in US treasuries, sell at a massive loss, and thus hurt yourself. Regardless, China dumping has captured the imagination of the mainstream and the Trump team, and for some reason think it's a real threat. Going forward, we're likely to see a reduction of foreign holders of US debt and deregulation of US banks to hold more US treasuries. Let's talk about trade. I'm sure you've seen a lot of TikToks for and against tariffs and the trade imbalance. Here's the real data. America imports 3.3 trillion of goods while exporting 2.1 trillion for about a $1 trillion deficit. But I don't think people know much about the trade imbalance for digital services. Here, the US imports about 131 billion while exporting 705 billion. If we take goods and services into account for trade deficit calculations, the reality is about 4 to 500 billion. Granted, part of the argument is that the Chinese have stolen US jobs and factories. The reality is probably somewhere in the middle. We traded US jobs in the lower value added sectors for cheap goods and more service jobs. Paraphrasing comedian Dave Chappelle, why do we want to work that hard to make Nike shoes when we can just buy and wear Nike shoes? Specifically on China, here's a quick list of sectors and dependencies between the US and China. The US is self-sufficient in many critical sectors such as energy, agriculture, defense, and IT tech. We do have alternate suppliers in many consumer goods, but those countries like Vietnam, Thailand, and Mexico definitely have Chinese influence embedded in their factories. But for the US, we must import critical metals, batteries, solar panels, electronics from China. We just don't have an alternate supplier globally that could fulfill our needs. For China, they have alternate suppliers for almost everything except airplanes, kind of, and cutting edge semiconductors of the 5 nanometer and smaller variety. As the trade war evolves, pay attention to the sectors that are bottlenecked by China. There will be pain felt by both sides, but the pain skews more heavily towards the US, in my opinion. Now, as we scenario plan for this US China conflict, we also have to look at China's weaknesses. It's broadly known, and Besant often proclaims, that China does not have adequate US dollar reserves to service its debt and economy. This is a big deal. Like the US, China has massive debts, and they need to pay massive debt service to remain credible in the rest of the world. The only difference is a lot of their borrowing was done in US dollars. The US can magically print more dollars in a crisis. This sounds crazy, but it's worked since 2008 and no one has complained or challenged this. But for China, they have borrowed in a foreign currency and must pay their debts in a foreign currency, run by a semi-hostile Trump. Now, China's total debt to GDP runs well over 300%. You may have seen figures in China's debt being around 40 to 50%, but that's only their federal debt. In comparison, the US is relatively high of over 100%. However, China's structure is different. They allow their provinces to run massive deficits, while in the US, we don't allow states to do so. The provinces, ordered by the central government to grow, have enabled massive overbuilding of real estate and factories, and have worked with mega banks to ensure easy lending to anyone building infrastructure, homes, factories, a lot of which is poorly managed. What I'm saying is, although China's federal debt level is relatively low compared to the US, we have to take into account the massive debt sitting on the balance sheet of the provinces, a lot of which is terribly managed fiscally. The provinces are backstopped by the central government and remain a serious danger to China's economic growth. This chart is outdated, but since Trump's reciprocal tariffs, China has been allowing their currency to weaken to counteract the tariffs. During Trump 1.0, they used the same playbook and essentially negated the effects of tariffs. If a US dollar could buy 10 widgets with no tariffs from China, then a strong US dollar weak yen could buy 10 widgets including tariffs. However, with the current 145% tariff in place, no amount of RMB weakening will overcome the high cost of the tariffs. This is a short-term tactic by the Chinese that is doomed to fail. In reality, What China actually needs is a weak US dollar for their economy to survive. Yes, it would mean less exports to the US, but remembering my previous slide, a weak dollar allows them to service their massive debt more easily, and it prevents capital flight of rich Chinese trying to sneak money out of China. As a reminder, China is also constrained by its geography. The cheapest trade routes are through the oceans, but China currently does not have the capability to protect the red and yellow shipping lanes, which are controlled by the US. China has made great progress in building pipelines and rail connections through the blue areas, but they're more expensive and are easily cut off with a well-placed guided missile. Currently, China could probably take Taiwan at great cost, but it doesn't have the military power to protect or solve its current geographical challenges. Now, I do want to share with you recent media reports of quote unquote credible intel suggesting that China will move on Taiwan soon. As Trump escalates, China will respond in a tit for tat manner until it doesn't. China would need to be desperate to take the risks of either invading Taiwan or just barricading and cutting off Taiwan from the rest of the world. The effect would be the same. No access to Taiwan semiconductor would drop the global economy 10%. For China, the war calculus would entail how terrible their economy would be before and after, as well as their assessment of Trump's resolve to escalate and commit to a kinetic war over Taiwan. We know that Trump is not an idealist who would fight for democracy and justice. He escalates to de escalate, but his goal is to make a deal. So, I don't know if this credible intel came from Trump or Xi, but there's a validity to the logic. Now, as I step back, zoom out, take a look at Trump 2.0 so far, I can't escape this dilemma of philosophy. It feels like for Trump, the ends justify the means. The US is still the only superpower in the world, so asserting that power to the benefit of Americans is justified, even if others are angered or harmed. Conversely, how one achieves one's goals is often just as important as the destination. The sequence matters. As we've seen time and again in human history, great conquests that were achieved without the hearts of the people were often short-lived. Here's my whimsical take on Trump's sequencing and my thoughts on how I might have done it. Trump first started with Doge cuts and tariffs on Mexico and Canada. Then he added 10% global tariffs. Then he added global reciprocal tariffs, triggering China to respond. Now we're at a trade war with China. Next, Trump pauses reciprocal tariffs on everybody except for China, and he's trying to negotiate with all the other countries to step up anti-China tariffs in exchange for probably removing or lowering the reciprocal tariffs. He's doing this with half the staff that he had before at the State Department and Treasury. He's also pushing for tax reforms to hurry up and get passed in Congress, and probably we'll see deregulation and stimulus measures in the second half of 2025 or into 2026. I would have started with first deregulating the banks and building greater demand for the massive treasury refinancing that we need to do this year. I'd follow with the 10% global tariffs and then begin private negotiations to get everybody on my side to challenge China and build anti-China tariffs. I'd then really focus on ending the Ukraine war first before starting a war with China. Doge cuts would come later in the year after we gave everybody more time and made sure the government could function properly while we started to cut. I'd focus on deregulation and tax reform in the second half of the year, and then work towards boosting exports and weakening the US dollar with stimulus measures for key sectors, key defensive sectors to come in 2026. Now, going back to my what ifs page, here's what my crystal ball is saying now. Number one, Powell will not readily cut interest rates and will stick to data and facts regardless of what Trump and Bessent want. I do think he'll end QT and provide stealth QE if he sees systemic financial dysfunction in the banking system. Two, Musk is rumored to be leaving early, maybe this July instead of next July. Doge was probably blocked by politics from touching entitlements and defense cuts, so he doesn't have much more to do now. Meanwhile, Musk has made it clear that he thinks Peter Navarro and the tariff war is stupid. Personally, I think Musk's influence on Trump was a good thing, grounded in the reality of trade, innovation, and pragmatism in an AI world. Losing Musk is probably losing corporate America. I suspect that lobbyists will soon be, quote unquote, telling Republican congressmen to revolt against Trump. Three, yes, I think a Mar-a-Lago Accord is still a real goal of Trump, though he has complicated things by turning friendly allies into suspicious let's wait and see allies. Yes, I still call them allies because fundamentally Western countries share the same culture and ideals, which is still preferable to Xi's China. Four, since tariffs are a consumption tax, its inherent design is to decrease over time. As consumers revolt and spend and import less, then there's less tariff revenue. Rebuild manufacturing in the US, then less imports and tariff revenue. It's not a long term solution for generating tax income. Five, Trump has threatened Iran with negotiations or military attack. Iran is definitely under pressure and will need to make a decision soon. Regardless, Iran is losing power, especially after the fall of Hamas in Syria. Turkey and Israel will fill the void as the Saudis watch warily to protect their interests. Six, Trump initially bought into the short term pain for long term gain mantra, but he's already showing signs of wavering. The complaints are building and coming from all sides, especially from the elite. It'll likely show up in falling approval ratings and lobbyists soon, which risks the obedience so far of the congressional Republicans. The 10-year yield is not cooperating, and he's realizing he doesn't have enough control, ergo, the recent talks about firing Fed Chair Powell. If he does this, one word, global mayhem. That's actually two words. I don't think he will fire Powell, but I bet he will ramp up the public vitriol. In any case, each time he escalates, then de escalates. It's destroying his credibility, but I think Trump 2 is the same as Trump 1. He doesn't have the stomach for putting America really into recession. Finally, I'll skip 7 for a later date. For a macro hedge fund manager like Treasury Secretary Bessent, this chart is highly unusual and concerning. Typically, when stocks go up, bonds go down. And when stocks go down, bonds go up. When there's fear and uncertainty in the world, typically demand for US dollars and US treasuries go up as a safe haven. This time they have all weakened simultaneously. This is highly concerning and will be the focus for both Bessent and Trump. The most logical explanation of this abnormal market behavior is that Trump has gone too far and has shaken global trust in the US. To combat this, I think Trump-Bessent have a few things planned. And now my crystal ball. Caveat lector, listener beware. First, I think Trump will negotiate to cancel reciprocal tariffs in exchange for anti-China tariffs. This will force countries to pick a side. I don't know if this was always the plan or a smart tactical shift, but if Trump can convince the rest of the world to gang up on China, it would be a big win. Second, I think, though, that Trump will keep the flat 10% tariff and keep the 145% tariff on China. It just fits his goals and the public messaging he's crafted. Third, Bessent is already working on SLR deregulations and planning for Powell's replacement in May of 2026. He needs to boost demand for U.S. treasuries as soon as possible and wants to weaken Powell's influence. The talk on the street is to install a loyalist vice chair / shadow chair to publicly second guess Powell and the Fed. 4. I think inflation will actually remain low into the summer and won't kick into gear until the second half of 2025. Basically, there's been so much front running and stockpiling that we won't see the biggest effect of tariff inflation until after we consume that inventory and need to reorder. However, the fall and Christmas season is going to see much higher prices and rising inflation. Meanwhile, the US is definitely in a stagflationary economy and risks slipping into recession if Trump keeps his reciprocal tariffs as announced. On July 4th, US Independence Day, Trump will have a grand announcement about his tariff pause. It's going to be high drama, but likely a market positive. 5. I think the Fed will not cut rates at the May 7 meeting, though they could end the QT program. The Fed may cut once or twice over the summer, but since we import so much from China, there's no escaping the sudden supply crash and its effect on future rising inflation. Six, overall, both consumers, who make up 70% of the US economy, and corporate CEOs, who determine the hiring and firing, whether or not to build a new factory, will grow tired of the self inflicted flip flopping White House and simply stop spending, hiring, and investing until there's stability. US stocks will reflect this. Share buybacks, a cornerstone of the strong US markets over the last decade, will fall significantly, whether just to boost emergency reserves or to spend on capital expenditures for new factories. Meanwhile, Trump has signaled his disdain for China owning and benefiting from US stocks and companies, throwing a cold chill to all foreign investors into the US. With a weaker US dollar, foreign capital will find its way out of the US. Underlying all of this, however, global M2 liquidity is rising, with new stimulus from Europe and China, though I expect a level of capital nationalism, preventing that liquidity from showing up strongly in the US. It'll be range bound, swinging with new Trump proclamations, but never getting real traction. This is a market to sell any rallies rather than buy the dips. Seven, I do believe, however, that Trump and Bessent have a plan to reinvigorate and stimulate the US economy. They plan for short term pain and also plan to revive the economy harder and stronger to finish Trump's 4 years on a high note. I suspect they will unleash the stimulus plan in 2026, but Trump may pull the trigger earlier if he thinks he's losing support or control. Regardless, short of a miraculous Mar-a-Lago accord with China happening in 2025, where China kowtows to Trump, I believe alia iacta est, the die is cast. Trump has irretrievably broken trust in the world order and American leadership. I don't think Putin or Xi will play along easily, and they know to drag out the pain to voting Americans who will likely flip against Trump in 2026 midterm elections. Unfortunately, once you release the nationalism genie, it's very hard to put her back in the bottle. Trade, technology, information, defense, and capital nationalism will likely persist for a generation. We'll shift from collaboration to competition. We'll build the same factory on 3 or 4 continents, costing 5 times more than previously, which will first drive up inflation for 10 years before we can enjoy some deflationary benefits of overcapacity. With those thoughts in mind, again, I think the current market seems to be a sell the rally rather than buy the dip market, despite sufficient liquidity. Scarcity of trust will drive money towards scarce assets like gold, commodities, and maybe Bitcoin, as the US loses some of its safe haven aura in the US dollar and treasuries. Fiscal stimulus around the world may remain nationalist, which could boost international stocks while the US pursues fiscal austerity. Therefore, I think keeping a higher cash reserve is prudent. Although the broad strokes of Trump's method are clear, the short-term tactical shifts will still create uncertainty. Having extra cash will give the flexibility to quickly change lanes if opportunities arise. If the US dollar continues to weaken, international bonds in their local currencies become more attractive. Finally, for stocks, I think it wise to allocate an equal proportion to US and international stocks. For the US market, we should focus on companies and sectors that have pricing power, are primarily domestic, have solid cash flow even in a weaker economy, and or are in sectors with a Trump tailwind, like AI, defense, critical metals, etc. Globally, I like defense, Latin America, and commodity exporters in general. Now, let's just hope no nasty black swans add to the already challenging and changing world. It feels so scary when change comes, but I do think there's a method to the madness. There's always someone who's winning with their investments in any environment, and although there are many unexpected consequences when so many changes are happening, having emergency reserves and a strong understanding of how the engine is put together will be a competitive advantage in the longer run. Good luck out there. Bonus chart. Despite its crazy volatility, Bitcoin has outperformed stocks every year for the last decade or so. A key driver for Bitcoin is its tight correlation with global M2 money supply. The chart below is the M2 leading by 12 weeks, which indicates an upcycle soon. Of course, we don't know if this relationship will continue to hold up, but is it worth a small bet? As institutional investors and central banks are funneling money into gold, Bitcoin is also a global asset that's loved by millennials in emerging countries, as well as institutional investors and even BlackRock, the largest asset manager on the planet. Could Bitcoin, which is not controlled by any one human or government on the planet, become a new safe haven asset? Thanks for watching, and remember, these are only my musings and should not be considered investment advice. Be safe out there.